Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Today I thought I'd spend a little time talking about 401k plans. You know, as I go through tax season, one of the things I get to talk to clients about is how to save for retirement. And this discussion usually comes up when I'm looking at their W-2 form and I see that they're covered by a pension plan at work. Though not everyone has access to an employer-sponsored retirement plan, if you happen to have one at work, you should consider yourself lucky. And let's talk about why that is. And, let's start off by saying, what is a 401k plan? A 401k plan is basically a retirement vehicle where you can put away pre-tax money and earn, earnings on that, and it gets deferred in the year that you put that away. Now, and we're going to talk today about how this compares to like a traditional IRA or some other, after-tax saving vessel. So there was an article written here by Maury Backman, 6 great 401k features everyone should know about. And I thought these are really good features. And I thought it was a very, baseline discussion to talk about some of these things. So the first one is generous annual contribution limits. And what we're talking about here is, if you do a traditional IRA, the IRA is going to max out at $5,500 a year for workers under 50 and $6,500 for those who are 50 years and older. Whereas if you have a 401k plan, they'll allow you to contribute up to $18,500 for workers under 50 and $24,500 for 50 and over. Now, why is that important? Well, if you're only putting away $5,500 a year, I'm not sure you're going to have enough saved for retirement. So that's where the 401k really is beneficial. So you look, a lot of times I'll say to a client, I see you're only putting, a couple $1,000s into your 401k. Well, yeah, I just put, 2% of my income or 1% of my income. I said, well, there really is a benefit to putting more away. And one of the things that we talk about next, and this is number 2 in this article, is employer matching dollars. And what I'm talking about here is that, in many cases, 92% of the companies that sponsor a 401k generally match employee contributions to some degree. So, for example, let's say you have an employer that says, listen, if you contribute to your 401k, we're going to match on the first 5% of money you put into that. Well, if you don't at least put 5% in, then you're losing money. You're losing out on the potential just by participating in the plan. And I see so many clients that don't take advantage of that. I'll say to them, hey, I see you're covered by a pension plan. Do you put anything into it? Well, I really don't have the money to do that. And I've talked about that in another show, and you can go back and listen to that if you're interested. What reasons to not save for retirement. But then I'll say to them, well, does your employer match? Well, yeah, of course. I think so. They match about, 3 to 5%. I was like, well, then if you're not at least putting the 3 to 5% in, then you're leaving money on the table. So it's something to really consider, especially if your employer is doing a match. Number 3, tax-free contributions. And what I was talking about here at the beginning is when you fund a traditional 401k, the money you contribute goes in on a pre-tax basis, and your savings becomes a function of your effective tax rate. So what are we talking about here? Let's just say this. So let's say that as a couple, a married filing joint couple, you're in a 20% tax bracket. So for every dollar that you put away, you're saving 20%. So what I always tell clients is it's only costing you 80 cents to save $1. So that's where it really becomes a big boon to your bottom line tax rate, especially as your income grows. When you start to get up into the higher tax brackets, combined income, this can be a huge multiplier. You're talking about, and I always tell it, I say it to clients like this, this is a guaranteed return on your investment from the jump, right away. If say you're in that 20% tax bracket, you're not going to ever earn 20% interest. I hope not, at least inflation wise, putting that money aside in a bank account or anything like this. With the 401k plan, you're going to earn that right away. So even though eventually you're going to pay tax on that down the road, that's a 20 or 25%, maybe 30% tax return right away because, depending upon what state you're in, you may be able to claim that on your state taxes as well. Number 4, tax-deferred investment growth. When you invest in a traditional brokerage account, let's say, and we're talking about here as an after-tax, you're required to pay taxes on gains and each year you make these profits. But the beauty of the traditional 401k is that they offer tax-deferred growth on your investments. So you don't pay any taxes on any capital gains, on any dividends or anything that's earned in that investment portfolio that is in 401k. Now, of course, you have to do that when you withdraw it, but basically that money, stays in there and adds up, tax free. The other thing And this sometimes gets people in trouble. And I've talked about this before, is taking money out of a 401k. Because these IRAs, traditional IRAs and 401ks offer tax benefits for contributing, you're required to leave the money in there untouched until you turn 59 and a half, which sometimes presents a problem for people. Sometimes they put this money away and they find themselves jammed up and they have to get to it. Now, there are some tax-free penalty withdrawals that you can do for your 401k, depending upon, your circumstances. I'm not going to spend a lot of time talking about those, but there's something that is a benefit to these. I mean, in some cases you can borrow against it. In some cases you can make a hardship withdrawal, and we could talk about those later. Number 6, delayed required minimum distributions. So the money that you have in a traditional IRA or 401k, it can't just sit there forever. Now, this is the unfortunate part, and I'm starting to see as my population of clients ages, once you turn 70 and a half, you're actually required to start removing a portion of your account balance each year. And that's what we call an RMD, or required minimum distribution. And this is very important to make sure you get this right, because if you don't take your required minimum distribution, you can risk a 50% penalty on whatever amount you fail to withdraw. So that is something to make sure you're keeping an eye on. I see this with some of my clients that may have, multiple IRAs or multiple 401ks. Make sure you're looking at those investments and talking to your investment advisors each year to make sure that each of those is set up with the required minimum distribution. Because, for example, if you're required to take a $4,000 withdrawal and you didn't do it, you could lose $2,000 on that. And the IRS isn't nice about, waiving that penalty. You're pretty much going to lose that. Now, the problem with these RMDs also is that they automatically trigger taxes on your actual withdrawals, so that if you don't need the money, you wind up paying the IRS needlessly. The good thing about 401k is that in some cases, you can defer your first RMDs past 70 and a half. So as compared to an IRA, which requires you to take it at 70 and a half, if you're still working at the time that you hit 70 and a half, you can defer that so long as you're not a more than 5% owner of the company that you're employed by. So what am I talking about here? Well, let's say that you're working and you really feel good, health is good, you're working for a company, you don't own more than 5% of it, and you turn 70 and a half and you're still working. Well, you don't have to take money out of the 401k at that point. Let's say you continue to work maybe till you're 75. That's an additional 5 years in being able to put money aside, tax free. And you don't have to touch that money until you quit working. So I hope this has been really helpful as we talk about the benefits of 401ks. And it's really important because if you don't save independently for retirement, you're likely to struggle financially as a senior. So while your friends are busy traveling and enjoying time on the golf course, you're barely going to be scraping by. And one of the things they mentioned here in this article, and I think this is a pretty cool thing to think about, if you contribute a mere $300 a month to your 401k over a 40-year period and invest that money in an average annual return of 7%, you'll come away with well over $700,000. And that's something you could definitely live on.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.